Welcome everyone to Best in Interest. This is Shane back for a stock pick of the day video. It is Monday, January 27th here, almost wrapping up the first month of 2025. We're going to take a look at Broadcom. This is out of the information technology sector. Now, before we get too far in the video, if you could do me a big favor, it doesn't cost but a couple of seconds of your time, but if you could hit that thumbs up button down below if you find any value in the content, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Click that subscribe button down below. Hit the notification bell so you're notified whenever I put out any new content. I do this stock pick of the day video series Monday through Thursday. We take a look at a stock, run it through my screener, stock that's pulled back on the day, see if it is potentially presenting any value and worth throwing onto my watch list. And if it makes it onto my watch list, that doesn't necessarily mean I am buying. That means I am interested in doing more of a deep dive into the financials of the company. This is just an initial screener. And there is a thanks button down below if you want to buy me a cup of coffee, cup of tea. You can find that down there as well. Very special thank you to the subscribers and the viewers of the channel. You guys are awesome. The channel continues to grow because of people like you. Now, this is the vested interest stock screener. You can pause this and read through it here if you'd like, but it must meet 5 of 8 to make it onto my watch list. This highlighted in green here, that's for a company that is out of the financial sector, something like a bank, insurance company. Then we add in price to book, and it must meet 6 of 9. All right, back to Broadcom. Check them out on their homepage, www.broadcom.com. That's www.broadcom.com. That is their homepage where I pull this information from. Broadcom Incorporated is a global technology leader that designs, develops, and supplies a broad range of semiconductor enterprise software and security solutions. Broadcom's category-leading product portfolio serves critical markets including cloud, data center, networking, broadband, wireless, storage, industrial, and enterprise software. Our solutions include service provider and enterprise networking and storage, mobile device and Broadcom connectivity, mainframe, cybersecurity, and private and hybrid cloud infrastructure. Broadcom is a Delaware corporation headquartered in Palo Alto, California. And this is just some information from their webpage I pulled as well. You can read through this, but you can see here a lot of the different product out there that they have impacts broadband, Wi-Fi, app solutions, data centers, financial service solutions, enterprise security. So these would be some of the companies that they're out there working with and providing solutions for. Broadcom access solutions, automotive solutions. So maybe some of the over-air stuff that they're trying to do with these autonomous cars may be involved in that. You'd have to do more of a deep dive to find out exactly what they're saying, but that would be my guess there. We're talking about, again, www.broadcom.com. That is their homepage. Go check them out. Now, the reason we're taking a look at them, down, huge drop on the day, 17.4%. That is a massive drop. And is this just the beginning for the tech sector? Some news came out that maybe China's AI is maybe way ahead of America's, so big drop. And that may all be completely nonsense. It could be completely correct, or it could just be, like I said, nonsense and be presenting a opportunity to buy in the tech sector here in America. Or, like I said, is this just the beginning for the downturn in the tech sector here? But right now, we're going to take a look at Broadcom. Broadcom Incorporated, ticker AVGO. They are out of the information technology sector. Closed out the day at $202.13. Look at that, dropped $42.57 today. Huge drop. That's almost, it's, I think 20% or lower is considered a bear market. So that would be almost put them in a bear market territory. So if they drop 3% more here in the next couple of days, that would be a bear market for this company and potentially the sector overall. I have to see how much the overall sector dropped. But 52-week range is as low as $117.43, as high as $251.88. So it is actually still, even with this big drop, it is still kind of closer to its 52-week high than its 52-week low. Maybe that's part of the reason the drop. Maybe it just got out in front of itself a little bit. But market cap of $949.448 billion. So not quite 100 billion there. A beta of 1.19, so it is more volatile than the overall market. Price to earnings extremely high, $156.09 per share. That's $156.09 you're paying for every dollar of their earnings. Man, I'd like to look at their forward PE, because if it was this high, that's crazy. That seems crazy high. This has to be growing extremely fast to even be coming close to justifying something like that. Let's see what the rest of the numbers tell us. Earnings per share, $1.30 per share. Earnings date is coming up sometime between March 5th and March 10th. Forward dividend is $2.12. I believe their quarterly payers divide by 4 with a low starting dividend yield of 1.17%. Ex-dividend date, September 19th. It was September 19th. Looks like it paid out in December. So if you were to buy them now, you would get the next dividend, but you're going to have to wait a couple months to get it. 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $242.47. So they do see it going back up, but not quite back to its 52-week high. And I am not affiliated with Yahoo Finance. This is just one of the sources I pull information from. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially presenting any undervaluation. It's a quick way to check for that. 5-year dividend yield average is how we look at it. We look at their 5-year dividend yield average, 2.69%. We compare it over here, compare it to their current 1.17, over here forward 1.17, same number. And since this is lower than their 5-year average, that speaks to overvaluation, at least according to dividend yield theory right now. Now, I also like to look at their payout ratio. Their payout ratio is extremely high, 163.18%. That leaves me to believe they have potential for a dividend cut. They've got to be doing some things. They've either got a bunch of cash on hand they're paying that dividend out of, or they are selling shares into the market or taking on debt to be able to cover that dividend. But that is not sustainable. Over 100% payout ratio. Like I said, they're doing something else to make the difference. They're not getting the dividend out of free cash flow right now. They don't have enough to cover it. Dropping down to free cash flow, I like growing free cash flow over time because typically if a company has growing free cash flow, it's a profitable company, it's safe, it can buy back shares, it can pay down debt, make acquisitions, reinvest back in the company, and if it pays dividends, sometimes it will raise them as well as that free cash flow raises, and then that's what I like. Going back here to December 2022, here you can see $13.3 billion in free cash flow. December 2023, 16.3, so growth there of almost $3 billion. December 2024 up to 17.6, so still growing, and in the trailing 12 months looks like 19.4 billion. So it is growing free cash flow. They are repurchasing shares pretty aggressively as well, especially the last few years. 2022 was 1.2 billion of shares repurchased. 2023 was 8.4. 2024 was at 7.6, and a big jump up in the trailing 12 months, almost doubled that up to 12.3 billion in repurchased shares. So maybe they got a bunch of cash on hand or something, or they just had a bad quarter that threw this PE ratio out of whack, but that's really high PE ratio right now. All right, jumping over to stockanalysis.com. This is another source I go to for information. Again, I am not affiliated with stockanalysis.com, just one of the sources. I do recommend more than one source so you can make sure the information you are getting is accurate and up to date. Sometimes information is wrong, sometimes it's not updated every day. Now, they do have 25 analysts that have taken a look at this over at stockanalysis.com. They call it a strong buy. They have a low estimate of $161.60. If it drops down to that low, that would be a 20.4% drop from where it currently is. So could potentially drop another 20%. Maybe that's a better buy-in price at $161. Average estimate of $223.34. That would represent a 10.01% increase. That's a little bit lower than what Yahoo Finance had it on the previous page in the 240s. But their high estimate of $265 would represent a 30.53% increase. All the while, you could collect that 1+% dividend yield that it's sporting right now. Now, jumping into statistics, I like to look at return on equity and return on invested capital to see how well the company is investing its funds back into the business. To do that, we're going to jump over. I like 10% or better for both of these metrics, and it's got to beat both to be able to get the check. So return on equity, I like 10% here. It's at 13.46. That would get the check, but return on invested capital is just under at 9.68%. That would not get the check because both of them have to get it. So now, I've said this before. If it was this close and this was the only check that would keep it off my watch list, I would probably say 9.68% is close enough. But let's see where we shake out at the very end. Now, earnings per share growth, I like 5% or better projected over the next 5 years. Smoking high earnings per share growth is 63.19%. So that is extremely high. Now, I don't know if that justifies the 158 or 160 whatever price earnings ratio we saw, but this is extremely fast earnings per share growth. And if they do realize this, that's impressive. Revenue growth as well, forecasted at 18.52%. Now, this isn't part of my initial screener, but this is one of the metrics I do look at when I do more of a deep dive into the financials of a company. Look at their profit margins, their margins overall. Are they expanding over time and stuff like that? Are they paying down debt? What is their price to book? What are their PEG ratios? Compare them to other competitors. That's the type of thing you want to do whenever you're doing. Look at their balance sheet and the income statement. Understand those. If you don't, like I said, stick to index funds or ETFs. Now, quarterly payout ratio, again, extremely high, 176.01. They've either got a bunch of cash on hand, doesn't look like they're issuing shares, so they may be taking on debt in other ways to pay out their dividend payout, or they just had a bad quarter or two where it threw this off, but that's extremely high. Dividend growth of 13.91%, so they're growing the dividend, even though their payout ratio is way crazy. growth of 5 years. Buyback yield is negative, so they are not buying back shares at very opportune times, and shareholder yield is negative as well. Maybe they are taking on debt. That's something to look at. Now, they do pay out on the March, June, September, December timeframe like most companies do. Going back to June 2022, they were paying 41 cents. Looks like they jumped that up December 2022 up to 46 cents. December 2023 up to 52 cents, some fractions of a penny. Most recent rate, well, they raised it up twice in 2024, raised it up again September 2024 up to 53 cents, and then most recent was in December up to 59 cents per share. It looks like that's where it's still sitting at. All right, let's check the screener here. Understand the business. That's where we started, right? They've got their hands in AI. They're a chip manufacturer. They do tech stuff. Growing free cash flow the last 4 years, yes, and expected into the future, I would say so. Especially if their earnings per share growth they're thinking is going to grow as fast as it does, should impact their growing free cash flow as well. Growing dividend, yes, it's growing. Now with the over 100% payout ratio, I'm questioning should they be growing it? No, the dividend payout ratio is not under 75%. No check there. Dividend yield theory actually says they're potentially overvalued, so no check there. They are not within 15% of a 52-week low. No check there. Return on invested capital, actually, this is wrong. That should not be a check. But earnings per share growth was very, very high, over around 60%. So that one right there, because it was at 9.6, I would not give that check there. 1, 2, 3, 4. If I was to sneak this one in, it could potentially make it on the watch list. If you wanted to throw that one on there because the 9.6, 9.7, 9.8 right there, ROIC was that close, I could buy it. And that would at least get you into more of a financial deep dive of the company if you're really interested with it. But it is on the fence for me, so I would really take that out. It wouldn't meet. It would be 4 of 8. But like I said, I could be talked into it, so I'm going to leave it. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Let me know what you think of Broadcom down in the comment section down below. Is it one in your portfolio? Is it one you're watching? Maybe you're part of the selling that's going on right now. What are you looking at? Are you thinking waiting for more of a pullback for a buying opportunity, or do you think it looks attractive now with a 17% pullback? And do you think this is just the start for the technology pullback? Love to hear from you in the comment section down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So dropping them all down there below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. I hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.